Good evening, everyone, and thank you very much for joining us tonight. The session tonight is coinciding with the launch of the options game. It's the first of a three-part series hosted by Graham O'Brien, who's the Senior Manager of Equity Derivatives at the ASX. And over the next 3 weeks, Graham's going to be running a weekly training session, and he's got a range of different topics to cover. Tonight being the introduction session, where we're going to go through the basics of options, what they're used for, how they're used, what they are, and there will be an open session. There'll be a Q&A section. The reason I apologise, we're a couple of minutes late. We've been playing around. Graham and I have got a sound issue, so he can hear me. I can't hear him, which makes it a little bit difficult for us to go back and forth with each other. But predominantly the session will be run by Graham. So what I'll do is we'll manage that as best we can. And I'll try and fix my sound whilst he gets going. So thank you very much for taking the time for joining us tonight. Now, a couple of little housekeeping issues. If you've got a question, type it in, and I will, excuse me, I'll ask that question to Graham. We'll probably hold the questions to the end of the session just because of the issues we've got with this sound. But if that chat box isn't open, click on the top right-hand corner of your screen. There's a red arrow. It will launch the chat box. For those of you that have signed up to the options game, get in there, put in your practice trades. You can chat via the platform. Reach Markets provide the support. It's the same technology we use for our trading platform, and we provide the support during the game. And during the session tonight, if you would like to get access to our trade ideas, our education, if you'd like to have the platform on an ongoing basis, open a trading account, anything like that, just type in yes, and we'll coordinate that for you to get you a trial. All right, guys. Well, look, what I'll do now, quickly, I guess, before we start, any advice contained in the presentation tonight is general only. It doesn't take into consideration your personal circumstances, and you need to decide whether it's appropriate for you. So there's a couple of disclaimers I've put on there. If you want access to any of our disclaimers, you can visit reachmarkets.com.au. The other person that's online tonight, who I also cannot hear, is Ivan Cherrylove. Ivan built the technology that runs the options trading game. He's also a trader, lots and lots of experience in the market. Ivan will try and fix sound issues so we can bring you into the conversation at the end of the session tonight. But otherwise, Graham, I'm going to put my phone up to my ear so I can hear you. You can hear me okay. I'll now hand over to you. I might get you to just do a quick sound check.
Yeah, I could hear Ivan when he was talking as well, Patrick. So
all right, so everyone can hear each other except for me. All right, beautiful. Graham, I'll hand over to yourself. Thank you.
Okay, thank you, Patrick. So we're going to really go back to basics in this particular webinar session and really look at what options are, think about what some of the basic options examples, so it gives us a better understanding of what options were really created for in the first place. Look at the two different types of options, calls and puts, then go into some detail about different types of options that you can trade on ASX, whether they be ones that expire every month, ones that expire every week, whether they can be exercised at any time or not, and then some of our index options as well. So we're going to have a quick look into the game itself as well, and I think Patrick will probably pass over to you for that component. So what are options? I always like thinking about options before they were even invented. We've had options in the Australian market on the ASX since 1976, so let's jump all the way back to 1975. You had cash in the bank and you're thinking you wanted to do something in the equity market. What are some of the things that you could do with that cash? Well, there was really only two things you could do with cash way back then in 75. You could go long a position, go and buy a share, hope the share goes up in value, sell it at a higher price and make a profit. Alternatively, you could short sell a share, and for those of you that don't understand short selling, effectively it's selling something before you own it. What you're trying to do is sell something at the higher price, buy it back later at a lower price and profit from a fall in the marketplace itself. The only other alternative for investors was really sticking their money in the bank and earning interest. Back then the bank was probably a little bit better than the interest that you're getting today anyway. But really options were created to allow you to hold on to shares and not see them continue to fall if the market was during a crash. You could actually get out of that particular stock or protect ourselves. But really, options were invented to give us options within our portfolios. Generally, the reason why people start getting confused by options is really this basic definition. And I know when I went to university, it was quite difficult for me to understand options in the first place. And I think it was because of this definition. And I'll quickly read it out and then we'll go into some detail about what it means. So we've got this options contract, this agreement between two parties that conveys a right, but not an obligation to the person who holds that option. If they buy a call option, they have the right to buy an underlying security at a specified price within a specified time frame for an agreed premium. It's a massive mouthful, but let's have a look at some of those individual elements of this definition, and I think it will become clearer to us. So one of the examples that I like to use is using a housing analogy. And let's assume in this particular case, David wishes to purchase Mary's house, which is down the road, and he believes the house is worth $500,000, but won't have the funds or won't even have a deposit saved up enough in time until 6 months down the track. So instead of not doing anything at all, he decides to offer Mary $5,000 if she allows him to purchase the house at any time within the next 6 months if he chooses to do so. And he's going to purchase it at $500,000. If David and Mary entered into this contract for David to purchase Mary's house for $500,000 between now and 6 months' time when he actually gets that deposit, pays her $5,000 up front, they would have just entered into an options contract. And let's have a think about some of those other components that we saw on the previous screen. What is the underlying security in this particular case? It's Mary's house is the underlying security. The specified price that he's willing to pay in the future, $500,000. The time frame, 6 months. What is he doing in this equation? He's wanting to buy, so he's buying a call option, and he's paying $5,000 in premium up front for the right to buy Mary's house. So that contract details again. David has the right but not the obligation to buy Mary's house for $500,000 anytime within the next 6 months for, in return, for paying $5,000 up front. Let's skip 6 months down the track. Let's assume that house is now worth $600,000. David would exercise his right and buy Mary's house at $500,000. All it cost him was the $5,000 up front. If, however, the housing market fell, let's say the housing market fell to $400,000, David has a right but not an obligation. He would walk away from that right and purchase the house in the open market at $400,000. Once again, the most it's cost him is $5,000. So when we're purchasing options, we have rights and not obligations when we're buying options in the marketplace itself. So let's have a quick look at some of those variables again. And what we're using here is a payoff diagram. On the vertical axis on the left-hand side, you can see profit and loss. Anything above that dark black line is profit. So the dark black line effectively means the market price of the house. So as the market is moving up in value, we can see that the market price of that house will be going up in value. Use Mary's house or the underlying security. The expiration date is 6 months. The type of the option is a call, and the premium we pay up front is $5,000. If the housing market was below $500,000, David has a right but not an obligation. The most he can lose, even if he doesn't exercise that right, is $5,000 in the equation. Hence, the loss is limited to $5,000 in this case. The strike price or the exercise price, $500,000. And once the house goes up in value, that's when David is going to start making some money in the transaction. He needs for the house to get up above $505,000 before he's going to make a profit. $500,000 cost of the house, he paid in options premium up front. Anything above that is when David's going to be making money. If the house got up to $600,000, like I said in my example, well, David has made $100,000 over the price of what he would have purchased that house for, but it cost him $5,000 to enter it. So his total profit in that case, $95,000. So if we're buying call options, you want markets to go up in value. And as long as you cover your premium and the underlying that you're purchasing over, whether it be a share or an index on the ASX, as long as it goes up, than the premium itself, that is when you're going to be profitable in buying call options in options markets. So let's reiterate some of those key terms again. David has bought a call. He has the right but not the obligation to buy the house. Him as the option buyer has the right to purchase the underlying instrument, Mary's house, at $500,000, which is the strike price or specified price. Time frame in which he can delay his decision for 6 months, and the option premium buyer pays that $5,000 for the right. So when we're buying calls, we want markets to go up, and we want the market to go up by more than what we pay for the options premium itself. Mary, on the other hand, we haven't really touched on Mary too much. She's actually sold this call option to David. Mary has the potential obligation to sell her house. If David exercises his right, let's say the house went up to $1 million, Mary still has to sell that house for $500,000. She has no choice. She is obligated. And the option seller is obligated to sell the underlying instrument at that $500,000 specified price. She is obligated for 6 months. But the real reason that Mary's agreeing to this obligation is the $5,000 she's going to earn in an income stream. That's a very, very popular trading strategy that people use in options, selling call options over the stock that they own to generate an income stream over and above dividends. So let's now look into the put side of the equation. Hopefully I've given you some understanding of the way that calls work in the scenario. So a call buyer, in the top line here, we can see a call buyer has the right to buy 100 shares. When we start thinking about options over shares themselves, we're now talking in 100 share units. So we don't have options over houses on ASX, we have options over shares. Call seller, Mary, would have had an obligation to sell 100 shares in that location. A put option, on the other hand, this now gives the right to sell shares. A put buyer has the right to sell shares. I often think of people who purchase put options, especially over shares that they hold. They're actually purchasing insurance on their shares. So you could imagine I've purchased or paid an options premium up front for the right to sell shares. If that company goes bankrupt, I still have the right to sell those shares at the level at which we determined on that strike price. Think about it in insurance terms. We can buy car insurance. We pay a premium up front for our insurance premium. If that car is written off, we claim on that insurance on the agreed value of that particular car. Similarly, in options markets and over shares, we've got that agreed value, which is the strike price. We can claim on that agreed value if the market was to fall. A put seller, on the other hand, is like an insurance company. They have to buy those shares no matter how far that share price might have fallen, even if the company had gone bankrupt. So put buyers want markets to fall, or if I'm protecting the shares anyway, I'm protecting against a market fall. A put seller, they're trying to earn that income. They're trying to earn that premium just the same way as insurance companies do in insurance equations. So whether you're a buyer or a seller, they come with a certain right or obligation depending on your position. So if you're going long a position, you're effectively the option buyer or the taker of that option from someone else. You have a right. If you're a seller of an option, you are shorting that option, or you're the option seller, and we are the writer of that particular options contract. We have an obligation as a seller. So one thing you're going to take away from today's one-on-one, if you're paying money for an option, you're generally taking a long position, you're the buyer, that will mean you'll have a right in the future. If you're receiving money from the options market for that trade, you'll have an obligation to do something in the future. So calls, buyers of calls in that top left-hand quadrant. We have the right but not the obligation to buy. David, in the example, if the housing market fell, wasn't obligated to. You could simply purchase it in the open market. Put buyers, on the other hand, have the obligation to sell. They want markets to fall instead of rise. Call sellers are obligated, but they're obligated to sell something in the future. Put sellers are obligated, but they're obligated to buy something in the future. So let's have a look at some of the stocks that you might be able to trade options over. And I know Ivan and Patrick have all of these stocks within the options game itself. So we now have 81 single stock options available to investors in the marketplace, one exchange traded fund, which is over the S&P ASX 200 index, STW, and one index option if you have a view over the entire index or index movement. You can trade an XJO option, which allows us to be able to take a view on the S&P ASX 200 index itself. So a whole range of different stocks that are available to investors to take a view of whether they think the market's going up or down through call or put options. We do have options that are expiring at different times on the ASX though. Weekly options, they have expiry dates that expire each and every week in the marketplace, and they really do allow for a greater flexibility for short-term trading opportunities. So if you think a very short-term movement or a one-day event, purchasing a weekly option may be much more cost-effective than purchasing a monthly option to be able to profit from a short-term market movement. Monthly style options, they expire every third Thursday beyond. So we're kind of in this hiatus period with options that are listed on ASX. Some about beyond June 2020, they actually expire on the third Thursday of the contract month itself. I think the easiest way is whether it's through the options game or whether it's through your broker, just look at the expiry date on the actual screen itself. And do you think the stock will move within that time frame is probably the best way to start trading in options. We also have both American and European style options. Exercise on any day that they want, all the way up until the expiry date itself. Sellers should be aware that they may be assigned at any point over that life that they're actually sold that option. And the days to really watch out for are around dividend times. If I buy a call option, I don't have a right to a dividend. The only way I have a right to a dividend is through owning the shares themselves. The only way I can own the shares is exercising my right as a call holder and buy the stock. So if I want to get a dividend, I'll exercise early in that case, and sellers need to be wary around dividend periods. European style options, on the other hand, can only be exercised on the expiry date. They generally have a strike price 1 cent above what the American style option would be. Once again, just check the game's site. Look at whether it's an American style option or a European style option. Much easier for you to determine which type of option you're paying. Generally, European style options will be cheaper than American style options because I can only exercise my right on the expiry date itself. European style options, for sellers anyway, are often utilised to avoid exercise for dividends. So if as an option seller you don't want to be obligated over the entire life of the options contract just on its expiry date, then people will sell European style options. Importantly, on the expiry day itself, regardless of whether you've transacted an American or a European style option, all in the money options are automatically exercised on expiry day. So even if they're 1 cent in the money, you will actually make 1 cent from that options transaction on expiry day. They will be automatically exercised on your behalf. And we haven't touched on index options as yet. Index options over that S&P ASX 200 index, in the game itself, look out for XJO as the code. And they are similar in a way to equity options in that they have calls and puts. You buy a call if you think the index is going up, or you buy a put if you think the index is going down. But it's your view on the index as opposed to individual shares within the index itself. There are some key differences though with index options. They can only be exercised on the expiry date. They're only European in style. And also, they're cash settled. We wouldn't expect at expiry, in the case of individual shares, the actual shares transfer hands on exercise. With index options, it would be quite onerous for you to deliver 200 different shares in the index at the correct weighting to someone else on expiry. So instead, we cash settle those instruments. And basically, the cash that is settled is the difference between the opening of the index level and the strike price or the settlement price of that particular option on the expiry date. That's another one of the key differences about these products. Index options, the settlement value is determined on the opening of the market, whereas with share options, the settlement value is determined on the closing value of the marketplace itself. So today was actually an expiry day for a monthly expiry of share options. The price that will be used to determine whether an option is in the money or out of the money is the closing price of those shares. However, today was also an expiry day for weekly options in the index. that wasn't done on the closing price, it was done on the opening price of the index itself. And finally, strike price and premiums are all expressed in index points rather than dollars and cents. The easiest way to convert that into a cash value when you're trading index options is that one index option is worth $10, or one index point, sorry, is worth $10. So if we have a 6,800 point index, which is around where we are at the moment, that would be worth $68,000. So hopefully that's given you a quick 101 on these are the types of options that we have available on ASX, and it helps you in maybe starting your journey within the options game itself. For those of you that want to explore a few more even outside of options, we did have our recent ASX Investor Days, both in Sydney, Melbourne, and Brisbane. We taped the Melbourne session, so we've just provided you with a link on the screen there of some of those recording of videos if you wanted to go back and have a look at what some people might be thinking about the market, whether they think the market's going up, down, sideways in the future, or even some trading style strategies in the trading stream itself. Ivan and Patrick, that's my component of the presentation. I know I've got a slide in here which actually points to the options game itself, but I think it's probably better off pointing over to yourselves. I'm sure everyone that's dialed in at the moment know there's a grand prize of $500 and you're providing that $100 brokerage and from implied volatility itself. What have we got? Three and a bit weeks to go in the game, and a chance to win that grand prize of $500. So I'm going to pass back over to you guys.
Absolutely. Thanks, Graham. I managed to fix my sound issue so I can hear you clearly now. Nice. So yeah, again, if you haven't registered for the game, the address is at the bottom of the page there. I've sort of got my mouse over it at the moment. You can just register there. There are the winner of the last game is promised us he's not going to play this game, so it's open. It's wide open.
I saw him play.
All right, now I'm going to.
Are we able to drop those links onto the chat box? Just in the last slide that Graham had, just for anyone who wants to watch the video links. Yeah.
Yeah. Let me go and do that for you. Just one moment. I can only do one thing at a time. You know that well, Ivan. Here we go. Copy.
Mate, on the best of days.
On the best of days. All right, that is not working what I'm trying to do there. All right. Delete.
That's right, nothing like computer problems.
All right, almost there.
And while Patrick's doing that, Graham, there's a question for you, whether these slides will be made available.
I'm more than happy for yourself and Patrick to make them available.
Perfect. Right. We'll also make a recording available as well.
Yeah, we'll make the recording available. The slides, David, we will send to you. No problem. I'll get someone to email them to you. All right. Let me open up the game. So has anyone got any questions at all for Graham regarding anything that he covered tonight or just in general? I'll let people type away. What I'm doing in the meantime is logging into the options game. All right.
Are you on that small computer again?
I'm on your favourite computer, Ivan. It's a little bit slow, let's just say that. All right. So for those of you that are new to the game, when you log in, you open up onto this screen here, and you'll have a range of different things, but if we've got any webcasts or anything like that, we'll post them on this screen. But generally, where most people navigate through is through the strategy builder. Now, I'm not going to go into a tutorial on the game in this session. There are some, I just want to point out that there is an education portal at the top right-hand corner. And if you click on that, it will open up a whole range of different education videos you can go through. Ivan, have you started your 10 by 10?
Yeah, so for anyone who signed up, the 10 by 10 comes out straight away. So 10 daily 10-minute videos starting from what a put and a call is, which will be a great rehash to today's webcast, or today's was a rehash to that, depending on when you started, going to spreads, going to trading systems, and sort of everything in between, right all the way up to Graham. I must admit I've stolen your slides for the market maker conversation piece. So if you've noticed your slides, I apologize.
It's all good. I think we're actually going to touch on them in one of the other sessions, aren't we? In next week or the week after. So.
Yeah, I think, on the 10th, I think we're getting into that. So next Tuesday, is it the 3rd? We're doing the next session?
Yes, that's right. I'm in Melbourne. I'll be joining you there live, Patrick.
Oh, excellent. All right.
You guys might be able to check out my new studio.
We have got on Monday a trade group discussion on Monday that anyone can register for as well. So we'll put that up in the game. You'll be able to register. You should be getting a daily newsletter from us, which gives you a technical update on the market, and we'll also point out any trades that we're seeing. And on Monday, because of the market's been quite strong, there are a lot of trades that have presented themselves over the last month or two that have been doing very, very well. But there's been probably more trades that have come through our trading scans in the last week than we've seen for quite some time. So we've decided on Monday to run a trade group discussion on Market Open to have a look at those.
Is the market ever going to come down?
One day it will, and
and it will come down hard. But right now, look, anyone that follows any of the things we've been talking about for the last year, we're just trading a technical bull market, and there's been opportunities to do some bearish trades, but predominantly they've been bullish all the way through. So we just stay with the trend. And so Monday we'll be talking about some of the strategies that we use. Now, anyone who would like to use the technology of the trading game beyond the game and would like to get a trial, type yes into your chat box now. Anyone that would like to get access to our trade ideas, our education on, you can type yes, and we'll also give you a trial so that you can access that. But bar that, I think we've covered everything we were going to cover in tonight's session. I haven't seen any questions come through other than the query about slides and so forth. If anyone has got any questions they'd like to ask any of us on the session, please type them in now. Otherwise, if you come along to the Monday session, that should be quite interesting. We'll be trade focused on that session. Tuesday night, Graham's going into the next session in this series. Wednesday day, we've got a trade group discussion again, a bit more of a broad chat about the market. There's a newsletter coming out every day for the game players. We'll be commenting on any trades that line up and meet our rules as we go, and that you can follow those in the newsletters as well, and enjoy playing the game. And as far as the league goes, Ivan, do we have a look at the league now? Have a look at.
Yeah, sure. And while you're bringing that up, because your computer literally will take about half a year. So while that's coming up, and of course, as I say that, it actually comes up straight away. Phil Ward, wow. So he's one of the developers that is building the magic that is behind the trading platform. Good to see him at number 2. He sent me a image going, mate, I resign. Options is my new life. Anyway, he hasn't, but so just one of the interesting things around about what Patrick was saying as well. So on Wednesday, so every Wednesday we did the trade group conversation, and the reason why we're doing this extraordinary kind of meeting on Monday is because as part of our trading rules, we have a specific set of days that we're looking at. We're just in terms of optimal options time decay type stuff, which is something that you'll sort of learn as you go down the journey. And so we were waiting for the optimal time to kick in. So Monday is going to be a very exciting day for us.
It will be. It will be. All right. Now, there are a couple of questions. Tom has asked, I have some questions about the game software, basic usage questions. Is there a video that will run me through it? Thank you for that question. There is. and we will get that sent through to you, Tom. Ivan, we were going to maybe put the one that's been done. I know we're working on another one in the education portal.
Yeah, and actually, we ran a webinar last game with Tim and myself, and you were in there for a bit before you had something important we had to run off. But that was a really good session as well. Maybe we dig that one up actually. We did that on another day. So that was actually
yeah,
that was a really good one because a lot of people found that really helpful.
Okay.
So maybe we'll send that around.
We'll send that out to everyone then. Yeah. Do you want me to organise that to happen?
Yeah. So that's in webinar job. So if anybody does want that, please obviously let us know. Just say intro video or something like that, so we know specifically what you're looking for. If you're finding it a little bit difficult to place the first trade and get started. Hey, what time are we doing the Monday webcast? Was it 12 or was it 11? Do you remember?
I'm checking my calendar now. I thought it was 10 o'clock.
Fair enough. Then we might have to move it.
12 o'clock. I think it was 12, right? 12 o'clock. Yeah. Perfect. All right, so 12 noon, it will be in the newsletter, so you can opt in via there, or you can say type intro into the chat box, and we'll send everyone an invite. All right, now there was a question by Peter. Should I be buying calls on Westpac for June? All right, now
I'd love to ask this question to Graham, but I know Graham can't give any kind of general or other advice. But
that's exactly right. You've beat me to it, Ivan.
Yeah, I'm happy to talk to it if you like. But yeah, Ivan, did you have something you wanted to say?
No. Just it's.
Okay,
I legitimately want to hear Graham's advice on it.
In the game, right? You're trading short periods of time. I don't know, as a game player, whether I'd be buying a long dated option. As someone that is a trader trading technically, well, no, there's a million ways of looking at the market. We just have one way of doing so. Looking at this, it's looking pretty bearish. If I was forming a technical view, I'd probably be close. It's sort of getting close to meeting my rules for going short. Not quite there in one of our trading systems, but as a game player trading a little bounce or something like that, yeah, you wouldn't be trading a June option. If you're an investor, well, that's quite a long dated option, right? So if you fundamentally believe the banks are going to recover, then that's a view you would form based on information that I don't observe. I don't know about you, Ivan. Would you say anything else to that?
Yeah, 100% agree with you. I mean, the big thing about this is that when it comes to the game, if you expect a move that there's going to be a bounce, you buy a December call option, just because that's sort of around about the time when the game expires. Well, if the game finishes one day after the expiry date. So you'll get the most amount of benefit if you get it right, or you lose everything, just to put that into perspective. In terms of a real trading investment, I mean, the reality is that for everything that we look at, the price has some serious selling momentum behind it. Before you start getting into this, you'd at least wait for some consolidation if you're an equity buyer. But, what do we know?
Yeah. It would have been interesting to see what its IV rank was earlier in the week, Ivan, around Monday. It would have been nice and high, I would have thought.
Yeah, well, I mean, if you look
at that... Probably come off a little bit now, but...
Yeah, well, I mean, even if you... interestingly enough, in late Gen, it actually got higher than it was here. So it was interesting, despite all the sell-off, the put participation wasn't there, right? Which was interesting. Oh. Although, actually, while I say that, you probably have much better data than we do on that one, Graham.
Can't comment, sorry.
Anyway, it would have been about 50, but it's come right back, right? So now, Tom has asked, are there any bell curve overlays for the game software?
So interestingly enough, actually, we are in development with some of those sort of the good old bell curves which show you the standard deviations. We haven't put them in. just sort of had a whole bunch of stuff thrown at us, which was sort of high priority. But having said that, we do have something. If you go to volatility.com.au, this is something that we put up last week. Actually, Patrick, maybe you can bring it up, and it redirects to something that will give you specifically that, and it's a free resource for anybody to use. So volatility.com.au, if I remember my links correctly, will put you to a pretty cool little calculator. So all you have to do there is just type in the stock, and any stock that has options over it, you can go on and type it in.
I like some Ipsum quote there, Ivan.
Well, I'm glad that you gave me all those. Half a year ago, you gave me all those events that you were running.
Yeah.
But but that's so that effectively.
Yeah.
So you've just typed in Westpac. Westpac has an IV rank of 25, IV rank implied volatility of 16. Pick the expiry date roughly, and what it tells you is using standard deviation working backwards on implied volatility, and we'll talk about implied volatility in another webcast. But if you say 10th of June 2020 as Patrick just selected, you can say, okay, the first kind of level is a 68%. The one standard deviation using implied volatility means that there is a 68% chance that the market is pricing in of a move between 2180 and 2750, 95% chance of two standard deviation between 1895 and 3035, and a 99% chance of 1610 and 3320. The interesting thing about all these numbers is that we've done the numbers on this. We gave it to our quants, data from January 2016 till middle 2019 from memory, and then the expectation from standard deviation to what is actually happening, there was a very close correlation between what the market expected and what actually happened. So over short periods of time, implied volatility in Australia is priced very, very, very well.
It is.
I'm glad you like that one, Tom.
Yeah, it's pretty cool.
It's a bit of a forgotten gem, isn't it? We completely forgot about doing it. Just that bell curve just reminded me.
Yeah. That's good. All right. Any other questions while you've got us? All right. I'm not seeing anything come through. I think we've covered everything we wanted to cover. Again, if you want to have a trial ongoing using this technology or adopt it to help you with your trading, type in yes. If you would like to get access to our trade ideas, we have quant analysts checking all our hypotheses, and we've got a lot of data behind what we do a lot of education around it, and if you would like to get access to that, those trade ideas, you also type in yes. And there's a lot of education and so forth that we provide through this process, and if you want access to the ongoing webcasts that we run pretty much a couple every week, then also type in yes. And we have a team of advisors. If you're looking for a full service advisor in this as well, type in advisor into the chat box, and we can organise to get somebody in contact with you on that front as well. So thank you for all those people that have requested more information. We'll get that out to you tomorrow. As far as a late question on BOQ.
While you're bringing that up, are players mainly call buyers or put buyers? Typically, we've seen in the game, when we started the game, pretty much everyone who won was a call buyer or put buyer, which was effectively a form of, on many levels, gambling, where they would put $50,000 on one call or one put, and then if they got the direction right, that closed it down immediately. What we've seen in the last couple of games, as we've had a lot more education, which was really what a lot of people have asked for, which I guess makes sense if people are coming into options for the first time and trying to learn. But as we've put a lot more interactive education and other sorts of the education portal in particular, we've seen a lot more people in the top 5 actually make money out of not just buying calls and puts, but proper trading systems. And part of that was also we've had our trading system run through in the background, and that's performed relatively well, although we've sort of leveraged it a fair bit. But it's been really good to see a lot more spreads in the mix, a lot more are in condors, some of these more advanced strategies that you'll learn about as we sort of go on in our education journey.
Absolutely. All right.
Can this is a question for you, Graham, by the way. Well, again, because I know what you're going to say about VOQ anyway, Patrick, but Mark asks the question, perfect for you, Graham. When will liquidity in equity options improve?
The thing is that I think also you guys were actually pointing it out at how fairly price volatility is in the Australian market. The thing is that the market makers that are providing the liquidity are pricing things so fairly and tightly in the market now that people actually have the liquidity there. They just have to be smart about how they're actually trading in the market itself. So I would always suggest prior to putting orders into market asking quote requests, because you'll find that the traders will actually tighten up their spreads on screen for you. But we have more market makers now than the options market had 7 or 8 years ago, and that point that you made before around the volatility being very close to where the market actually is, the competition is actually driving things to be much more fairly priced in the Australian market now.
Mm. The other interesting thing is, so the follow-up question to that, or I guess comment was, ever since Optiva left, the spreads have increased. And the interesting thing that I found is, so we don't do quote requests through our platform. We have a theoretical price and a two-way, a kind of extreme trading range spread, or an estimated trading spread. And we've had a couple of people say, oh, look, let's do quote requests and whatever. But the majority of our trades that we see go through the system actually get filled around the theoretical price. And obviously there's that whole, 5 years of experience of building risk management systems for the market. Obviously we work very closely with the ASX in terms of using the volatility curves that come from the market. They've got an extremely sophisticated system for pricing up volatility. And in most cases it's very accurate. So although the spreads may have widened, that doesn't actually mean that the prices that you get filled in at have. So, again, if you're trading something that's completely, on the low level of liquidity, it's sort of a thumbs down in the strategy builder, or sorry, the stock screener, and, there's sort of one or two market makers officially, two or three market makers officially quoting in that, then you might be paying a couple of ticks over where you'd be expecting your spread. But in reality, if you're trading stuff that's not too far away from the money, not too odd in terms of expiries, it's well within sort of 6 months, some maybe 9 to 12 months to sort of slightly leveraged extent, you're going to get filled, and you're going to get filled at a decent price. So I don't know, Graham, you'd probably have an opinion on that as well, but seeing all of the data.
Yeah, all of the data, the one thing that there is a skew in the Australian market is through people selling. So there is definitely a skew that more people sell options than buy options. So when you're buying options in the options market at the moment, you'll find that you actually get a better fill because it's actually suiting all of the market makers with the books that they're holding, because they're forever buying options from people because there's one-way flow from sellers in the options market. So you're actually going in to buy options at the moment. They're actually selling at very, very reasonable prices.
That's actually really, really interesting. So, for example, if you had a view on Westpac that it was going to change from the current price, the kind of strategy you do right now is, buy a call and a put, right? I mean, if based on what you're saying is, those kind of strategies can be awesome, right?
Yeah, if you're able to pick it up cheap. You have to be smart in the way that you're actually putting your orders in the screen, though. And I think your point that you're getting close to fair value, you're actually not hitting the offer or the bid and crossing that spread. Being smart in placing your orders in between.
For a lot of, when we've got a big trade idea out, and especially for iron condors, which market makers tend to be, I guess, they like doing it because the price doesn't move around a lot, and they don't like doing it because there's not a lot of delta in it. But we ask the market makers to give us a price, and honestly, for the amount of volume that we'll push through on one of those, which is quite significant, I have been so surprised as to how tightly guys like UBS and Susquehanna, who are sort of the two big players that we use for a lot of the stuff that we do, how tight the spreads are for sort of something that they won't really make a lot of money on. I think that, again, going back to liquidity, it's our market is
Ivan,
very tradable.
Now, we're going to be talking about market makers, I think, is it in the third session, Graham?
Yeah, that's correct.
Yeah. Which is, I think, people find very, very insightful. There was Mark, I think Mark's got one more follow-up question. I'll let you answer that in one moment, but I'm going to go to Bank of Queensland. I guess I guess what I'm getting from that, David, is you're asking for an opinion. Look, technically, it looks very bearish, but it's a difficult one to get set on a trade because, for us, we've got our trading systems, and we're going to be running a session. I believe there's one on next week on trading systems. I'll have to check it either next week or the following week where we go through the rules. But for us, we love to trade breakouts. And when we're trading a breakout, we want to know that the trend is with us, and then we want to see a break of a very important level of support or resistance, in this case support. And we saw that Bank of Queensland broke its 52-week low, I should say. That's not enough for us to get into a bearish position on it. We'd want to know that the trend was also officially going down, and we saw that happen probably a little bit too late in the play to want to get a trade set, purely because of the distance between the 50-day moving average and the share price, and there's probably reasons around that to do with the way that we set our trades up and also repair them or switch them. So in this case here, technically, I would say we are bearish, Bank of Queensland. It looks bearish, but it doesn't actually line up for us probably to do a trade on it. So we'd be sitting there observing, probably waiting for consolidation before setting ourselves up again.
But just one thing to add though, early in November though, it did present itself as what we call a lit short, because we did have a couple of clients on that, and that would have been, effectively we're just waiting for expiry date on that for those of you, for those people that got on. So at that initial breach of the 52-week low.
Beautiful. All right.
Last question. Do you want to ask that question for Graham? The follow-up question from Mark.
Oh, which one was that? There was when will hang on, my questions are out of kilter. Would liquidity improve if there was only US or Euro options?
The thing is that no, because in the end, the book that a market maker runs combines both of them. So they have benefits for both styles of clients. So sellers of options around dividend periods want to be using Europeans to not be exposed to dividend risk. But when it's American style options, it gives you more choice as a buyer. So overall, market makers look at their book on the entire stock, whether it's a European or American style option. It doesn't matter. We only obligate them at ASX to be continuously quoting an American style series though, so that helps with that liquidity.
Beautiful. I'm going to ask the last question. Before I do, I'm going to sign off, Ivan. I'll let you finish. I have to, I'm going to get in trouble by my wife and out for dinner tonight. So I'll let you sign off. But the last question is, with our market being primarily banking and mining, will we ever see options on XMJ and XFJ?
So the answer to that question is, if we do, it will be over ETFs, over those styles of indices. So one of the things that we're working closely with our market makers at the moment is looking for support to start quoting in international ETFs, so over international indices, and then some of the sectors can come in on the same basis. So I would expect that it's a watch this space and look out for more options over ETFs rather than the one that we have at the moment.
That would be awesome. That would be actually seriously awesome. Do you think that's sort of if it does happen, a next year thing or a year after?
So we have it in the pipeline for the first quarter of 2020. So we're not far away.
Wow, that'd be brilliant. Yeah, I know that there's a couple of clients that have been asking for similar questions. It's interesting, actually. I guess last thing I'll just say on some of those last questions. It's interesting how the same sort of questions come, and it's almost like there's sort of the same misconceptions around the Australian options market have been there for, I reckon, the last at least 6-7 years, right? Would you agree with that,
Yep.
Graham?
Yeah,
And
I think you're right, and it's not until a person actually physically trades in that market. When you just look at a spread on a screen, it does look wide, but when you're physically trading in there and in between the spreads, and you do find that market makers come down and meet your price these days. If you're doing
yeah,
large volume, it could be different, but most of the clients that will be utilising the game aren't doing the size of volume that's going to impact on the spreads.
yeah, yeah. I had a conversation with a lecturer at one of the big four universities. And he teaches options as a postgrad subject, and even he had some misconceptions around the way that the Australian market quotes. He goes, oh yeah, in US it's really liquid because you look at the screen and there's two-way markets everywhere, and in Australia you don't have that, which is in reality, at least from my experience from trading both markets, you know your top 20, you're never going to have a problem getting filled, and it's only really once you start getting down to the sub 50 top stocks that you start getting some issues, right?
Yeah, well, you need to look out for the ones that have less market makers. So having a look and where you have that ranking to show how many market makers are on a stock, it's an excellent idea. The more market makers, the better the liquidity, the better the competition.
Yeah, yeah. Well, thank you everybody for joining us tonight. I think we'll sign off with that. Look forward to having a more advanced conversation with you next week. Oh, sorry, the 10th.
Yes.
And thank you everybody for joining us. Thank you very much, Graham, for coming. Not that I'm going to say goodbye to Patrick since he's long gone before his wife divorces him for running webcasts every night. Anybody else, as a very last question for anybody who does want to get access to the trial, please press yes. Anybody who does want to get access to any extra material, let us know what you'd like. There's plenty of stuff going on. There's plenty of stuff that we can deliver to you, and we're always looking for feedback. Thank you all very much. We hope to catch you next time.
Thank you.
Thanks a lot, Graham. Bye.